All right. So we'll go ahead and get started. Happy Monday to everybody. It's hopped on here. So quick background. Obviously, this class is the pre-approval versus pre-qualified. It's going to be taught by Monica Barton. For those of you that don't know Monica, she's been in the mortgage industry for a really long time. She's seen just about everything, 20 plus years in different positions and different scenarios and different anything, you name it, she's probably seen it, dealt with it, and figured out a way to make it work. Um, but we're going to go ahead and hop in here. She's going to be teaching the class. If you have any questions whatsoever, you can throw it into the chat field there and just let us know. But yeah, we'll kick it right over to you, Monica. Get going here. Got 30 minutes or less.
I'm just gonna share, Abby's gonna share the screen, right, Abby?
You got it.
Am I good to go? Okay, awesome. All right, I wanted to talk about this topic because pre-qualified and pre-approved are often referred to as the same thing, and they're not. One of these significantly has a greater chance of getting your client to the closing table. So, before this class is over, you will know which approach I think is best. I think there is value in both, but one of these options greatly increases your ability to protect your sellers and buyers' interest. So let's dig in. You probably had buyers tell you, I already have a pre-approval. But what does that actually mean? Take a look at the slide. Which of these do you assume has happened when a buyer tells you they have already been approved? Full credit report reviewed, income verified, assets reviewed, automated underwriting completed, or you're just not sure what that means. There's no need to comment. We're not going to make you put it in the Q&A or in the chat box. Just something to think about. But if you're unsure what it actually means when someone says they have been pre-qualified, you're not alone. Today, these words don't mean the same thing from one lender to the other, or even from one loan officer at the same company to the next. So some loan officers perform an incredibly thorough review before writing a pre-approval letter, while others can generate a pre-qualification letter in less than 5 minutes. Today, we'll talk about the difference and what kind of impact each might have. So what is a pre-qualification? Let's go over that first. A pre-qualification can be done quite quickly. It comes from information provided by the borrower. It may or may not verify income, and it may or may not verify assets. In some cases, only a soft credit is pulled, and we'll go into that in more detail here later. A pre-qualification is simply an estimate based on information that's available. There's absolutely nothing wrong with it as long as everyone understands that's what it is. Now, a true pre-approval takes a little longer. Depending on the complexities of the borrower, it can be completed within just hours. It entails obtaining a complete application, a hard credit pull, income and assets documented, and then those things are analyzed by the loan program. And then that analyzed documentation and information is then submitted through an automated underwriting system or maybe even an actual underwriter prior to issuing a pre-approval letter. So a true pre-approval answers the question, can this buyer actually obtain financing under today's guidelines? So that's kind of a simple difference between the two. Now, we're going to discuss briefly the 3 C's of a pre-approval, which consist of credit. So when you're looking at credit, you're looking at the historical management of debts, the capacity, and that would be the repayment ability and stability, and then someone's capital, like the funds that they have available for the transaction. Where are they coming from? So let's start with the approach to credit. There are 2 ways a lender might look at credit. One is a soft pull, and the other is a hard pull. The soft pull is less invasive. It doesn't impact the score. Typically, only one score is pulled because of that. It provides limited information and it may not be used for loan approval. So eventually, a hard pull will be completed later on. A hard pull does impact the scores, but contrary to what most believe, it's only about 3 to 5 points, whereas a credit card balance close to the limit can sway a credit score by as much as 30 points up or down. A hard pull meets mortgage underwriting guidelines, and it provides a full picture from all three bureaus. So before we jump into that a little bit more, I want to share my unpopular opinion. This kind of goes against what the trend is right now. But in my opinion, soft pull pre-qualifications aren't nearly as consumer friendly as they're marketed to be. Lenders often promote soft pulls as this great way to protect a buyer's credit, but the reality is mortgage credit reports have become increasingly expensive. And soft pulls are also a way for lenders to reduce that upfront cost. And I'm sure, Jared, you could kind of chime in on stats, but I would say probably only between maybe on average about 25% of our credit pulls actually turn into a transaction, wouldn't you say?
Yeah, I mean, it's a significant number that don't end up moving forward for one reason or another. Could be credit things, could have nothing to do with credit whatsoever. But regardless, and maybe I'll be more blunt, like I just don't see the value whatsoever to the consumer over the for the soft credit pull. It's I just don't see the value at all. The entire value comes in the form of money saved by the lender in having done a soft pull because they're not going to rely on it for underwriting. So what good is it? It means nothing to the consumer. Like, and I think Monica, you'll get into this later, but like it really is marketed in such a way that it seems like it's a benefit to the consumer, which any consumer that really understood would know that the impact of one hard pull for the mortgage means nothing when you look at the fact that your credit goes like this just month over month with doing nothing anyways. Then you'd realize that one hard mortgage pull doesn't really matter, but it gets anyways. Yeah, well, I'll stop off the soapbox there, but I do not love the soft credit pull. It just provides no value whatsoever.
Agreed. Yep. In my opinion, they're being used in place of a full mortgage credit report that can actually be a disservice to the buyer, like truly. So why is that? Because a soft pull doesn't provide everything needed to determine whether a buyer actually meets lending guidelines. And it may not give the lender enough information to properly advise that buyer on what their true home ownership options are. The sales pitch is usually, let's just take a quick look without hurting your credit. I actually have my husband's a veteran, and one of the big lenders that really goes after veterans sent a little email that said it said something like something as soft as a whisper, like let's do a credit check as soft as a whisper, just as a way, it's just trying to, it's marketing it to be something like, this is so simple. But I think we need to ask ourselves as an industry, are we avoiding a tiny, like by trying to say it's a tiny temporary impact to the credit score at the expense of getting the information we actually need to give the buyer good advice, which I think is what you were saying there, Jared.
Yep,
I could go on for quite some time on it too, but I
same.
want to illustrate why we feel the way that we feel. So for those of you who aren't aware, even with all the discussion around changing credit scoring models and things like that and trying to simplify things, today's mortgage guideline rules are that they still require us to look at all three credit bureau scores. And one misconception is that we average the scores, and we don't. We take the true middle score. That means we drop the high score and we drop the low score and then use that middle score for qualifying. Now, what you're looking at on your screen is an actual snippet from someone's credit report. And you'll see here that Experian is showing a 689. So if I pulled a soft credit on this, I think that looks pretty solid, right? Yeah. If this were a soft pull and that was your only score that you're seeing, you'd probably feel pretty comfortable assuming the other two were somewhere in the neighborhood, because generally they are somewhere in the neighborhood. And after all, FHA's minimum qualifying score is 580, and conventional typically starts at 620. So at a 689, it looks like we have plenty of room. But remember, 689 doesn't qualify this borrower. The middle score does. So now let's look at the full credit report and see what the other two bureaus are actually reporting. So here's the other two along with it. So when we review the entire report, we see the actual middle score for this applicant is 555. And that's a 134-point difference from the experience score we just looked at. So credit scores can vary from one bureau to another because not every creditor reports to all three bureaus, and the information being reported can differ. You can see just how significant that difference can be on this actual report here. So whatever negative information is affecting Equifax and TransUnion clearly isn't having the same impact on Experian. So like I said, not all creditors or collectors report to all three credit bureaus. And that's why the information and scores can be so different. Now, imagine this buyer had been pre-qualified using only that 689 soft pull score. So they could have spent weeks looking at homes. Their agent could have spent hours showing properties. They could have written an offer, gone under contract, maybe even paid for their home inspection. And then when the full mortgage credit report was finally pulled, because that loan officer can't send it into underwriting until that hard credit is pulled, then everyone finds out the qualifying score is not meeting the minimum requirements. And that's a very different conversation to have at that point. And this is where I think the soft pull approach can actually hurt the buyer. Instead of identifying the problem up front and then helping them build a plan towards homeownership, they've been allowed to spend their time shopping for a house they may not even be able to finance. I would much rather have that conversation on day one and spend the next few months helping them become mortgage ready than have them fall in love with the house and then have to go over this with them. Now, similarly, incomplete credit information can also keep someone from moving forward when they actually may be ready. So here's another one. Remember, for conventional financing, the minimum qualifying score is generally 620. So if the soft pull is only showing us a 611, conventional financing appears to be off the table. And while FHA may still be an option, pricing and underwriting can become more restrictive when the qualifying score is below 620. So based on that one score, a buyer could easily walk away thinking, I'm not quite ready yet, or a lender could steer them toward a different loan program. But again, that's only one bureau. Let's look at the whole picture. So when we look at all three scores, the actual middle score is 627, and that changes the picture completely. A 627 meets the minimum score for conventional financing. And if FHA ends up being the better option at when the minimum is a 580, being at a 620 can also open the door to more favorable pricing and more flexible underwriting possibilities. If you're under 620 with FHA, you're getting landlord letters. You might have to put a budget letter together. There's just additional things, plus the pricing is just more expensive. So if we had relied only on that 611 soft pull score, we could have made this buyer look and feel less qualified than they actually are. And that really matters. A lender could unintentionally price them out of a payment they could actually afford, steer them away from a loan program they may actually qualify for, or even tell them they need more time when they're actually ready to move forward now. So that's why you want to educate your buyers why a hard inquiry is beneficial. All right, so if you have any credit questions on that topic, please put them into the Q&A, and we'll jump on those at the end. But I want to move on to income. So in my experience, most buyers really don't know how much income a lender is actually going to use for qualifying, and understandably so, they don't know mortgage guidelines. So when a buyer tells me, I make $90,000 a year, I don't base their pre-approval on that. I document where that income is actually coming from and how much of it actually meets underwriting requirements. And interestingly, buyers underestimate their qualifying income just as often as they overestimate it. Wouldn't you say, Jared?
Got to be pretty close. One thing
Yeah,
is for sure, they generally never really know because again, like you said, it's not that they don't know how much money they make, but it's like how much can we actually use? How long have you gotten or received overtime? Things like that that make it tricky for them to really hone in. But they're
exactly.
never generally at the number that we can use for qualifying. Very rare.
Yeah, they're not expected to know the guidelines for documenting income or what underwriting considers stable and predictable. That 90,000 may be exactly right, but depending on how it's earned, how long they've received it, and whether it's expected to continue, some of it may not be usable at all. Or on the flip side, there may be additional income they didn't even realize we could use, and that's why income needs to be analyzed, not just entered on an application. There are so many different ways people get paid, like so many different, right? Right, Jared? And what you see on the screen, like I'm sure Jared could add probably about 20 more different pay types than what I have on here. A buyer may even have several different types of income from the same employer, and each can be treated differently for qualifying. So, like you said, Jared, overtime, a buyer may tell us they make $90,000 a year with overtime, but if they've only received that overtime for a few months, we may not have enough history to establish that it's stable and likely to continue. And that could mean that some or all of it may not be able to be used for qualifying. And I think bonuses is another good example. A borrower may include their annual bonus when they tell me how much they earn, but when we verify it with the employer, we may find out that the bonus is discretionary, and depending upon the history and likelihood of continuance, we may not be able to use that for qualifying. And then, of course, there's self-employment, right? That one's a tough one based on how many things that you can expense. So a borrower might say, my business made $250,000 last year, and that sounds really fantastic. But until we analyze the tax returns and discover after expenses and allowable adjustments, the qualifying income might tell us a very different story. And that might drive us to look at different loan programs that then require different documents for qualifying. One is the bank statement loan that Jared's going to be teaching here pretty soon. And the reverse can happen too. Sometimes the tax return contains income or allowable add backs the borrower had no idea that we could use. So that's really the point. Borrowers answer the income question based on what they believe they earn. Lenders have to qualify them based on what they actually can document as stable, predictable, and likely to continue. So if that analysis doesn't happen up front, you can end up discovering a major income issue after the buyer is already under contract. And that can mean a terminated transaction and a big loss of confidence for everyone involved. So a true pre-approval analyzes and documents the income upfront. A pre-qualification may or may not. And that difference can be huge once a buyer starts writing offers. All right. So if you have any questions about income, again, please put it into the Q&A. But now let's talk about assets. So imagine your buyer tells you they have $25,000 saved, and you celebrate that because it's enough for the down payment. Then we review the bank statements and realize 15,000 was deposited last week from selling equipment. Now we need additional documentation. And if they can't document it, suddenly they don't have 25,000 anymore. Nothing really changed. We simply just learned more information. Assets, I would say, are one of the most overlooked parts of a pre-approval. It's not just about documenting the funds are available, but where the sources are coming from. In addition, is there any undisclosed debt that is going to be discovered by an underwriter? Those are firm loans. I don't know. What are some of the other ones, Jared, that just don't show up on the credit
I
report?
mean, it seems like right now every well, I don't know how many don't show up on the credit report because they're coming out with. I mean, I think I saw something the other day where it's like you can let's just put it this way. You can finance anything now. It's like, hey, you want that burger from, a nearby burger restaurant? Why don't you make it five payments? What are we talking about here? So yeah, like, and a lot of times what you'll do is when you review the bank statement, sometimes it'll show up in there as a recurring payment to something, and you're like, oh, what is this? And it's not like if we don't find it, us as like loan officers, if we don't find it, it just magically goes away. At the pre-approval or pre-qualification stage, at that early stage, it's trying to get as good of an understanding of like, hey, an underwriter's going to care. Like this matters per the program. So we do, if we do the work now, it means you don't have to do the work later. It means everything goes smoother, faster, quicker. You feel a lot more confident, everything like that. But there's a lot of them now. There's a lot of different ways to finance just about anything.
True, true, true. So while a pre-qualification might only be based off of the verbal confirmation of what the buyer has on deposit, or maybe a screenshot of the bank balance, right? A pre-approval is going to document the assets asking these five basic questions. Is the money there? And then is it seasoned or otherwise documentable under guidelines? Like, can we track it? So there's nothing wrong with selling equipment as long as we can track that through the guideline requirements. Can it legally be used for the transaction? And is there enough for the down payment, closing costs, and reserves if it's required? And will the buyer still have the funds available when it's time to close? So that's an important piece too. So to kind of recap, a pre-qualification tells us where a buyer hopes they are today, whereas a pre-approval tells us where a buyer's purchasing power actually stands. So hopefully that kind of really helps identify the difference. And kind of what I would like to say is that sometimes in our industry, there's so much focus on the buyer getting the letter that we sometimes can lose sight of the actual goal, where the goal isn't the letter, the goal is to get the buyer into a home. And that means doing the work up front, understanding the credit, analyzing the income, reviewing the assets, and identifying any problems before they become problems. Because a letter that falls apart once the buyer is under contract doesn't serve the buyer, and it certainly doesn't serve the agent who trusted that letter. So I'd much rather have a harder conversation at the beginning, create a plan if one is needed, and give that buyer a pre-approval we can have down the road with confidence. So while the letter gets them into the door, the work behind the letter gets them to the closing table. And that's what we're all working towards. All right, so I know that was quick, just a quick overview of pre-qualification versus pre-approval. I hope it helps you ask more questions when you receive those letters. And as always, you guys can reach out to Jared and I with any of those questions, and we're always happy to go over it. Now, before we get to any questions that could be in the Q&A, I wanted to let you know that we're working on the Q4 classes through the end of the year. These QR codes right here, if you scan them, it'll take you right to the websites to get signed up. But also just send Jared and I a message or send it, just let us know in the Q&A if you'd like us to sign you up, and we can definitely do that. The next class coming up is on the 14th of September. Like I mentioned, it's the bank statement loans, which is really awesome. You don't want to miss that one, especially if you work with self-employed borrowers. Like, you really want this information to be able to pass on. Jared, do you have, like, could you give us like a quick overview of what they should expect in that class?
The bank statement loan one?
Yeah.
Yeah. Really quick with this one, just in case it wasn't clear, both Monica and I do the deeper dive. The pre-approval, like we're digging in there, and we care very much about the end result, not how someone perceives the feeling of it early. I think in this industry, like you had mentioned, everyone's trying to do stuff quicker at, and in a lot of cases, the way that they're choosing to do stuff quicker is at the expense of actual quality work. And the problem that that comes into it is it doesn't necessarily, outside of time spent, it doesn't hurt me to do a pre-qualification letter that's total crap, and then it go like it impacts the
I was thinking
buyer.
this, Jared.
Yeah, it impacts the buyer, it impacts the agent, it impacts all sorts of parties, and it impacts my reputation, my ability to do more, or it should, right? If you don't have quality work, it should impact you. And so it's really important that if you, when you're getting the letters, because they don't mean much. It's a piece of paper that doesn't mean much behind it unless the work behind it is good, is that you're just asking questions to whoever that lender is about the work that they did or didn't do. So you can get an understanding of like, okay, this is where we're going to from there. As far as the bank statement loan class, it's the class itself is to teach about another alternative that can be helpful for those that may need it. Sometimes when you have a borrower that comes through the door, they have unique income or just unique anything, something that's unique that doesn't quite fit the mold, but it's not necessarily like they did anything wrong or something bad. It's like, oh my gosh, you have zero credit, or you have, like you foreclosed on all these homes or anything like that. But it's just different. And so sometimes having these other programs, which is really what the bank statement loan is, can open the door where otherwise the door may feel shut and they don't feel like they can buy a home. So we can give alternatives, and really what it is a different way of looking at income mainly. So if they're maybe self-employed and their tax returns aren't so pretty, but maybe their bank statements show a really great picture of like, look, they move cash in and out like clockwork every single month. Like you can build a history of this. You know exactly what you're looking at. Their business has been going on for a while. It just gives another avenue for them to be able to possibly purchase a home that under other programs may not be the case. And so we'll dive in there, see what it's good for and what it is not good for, and how people can benefit from just a little bit of, I wouldn't even say creativity. It's just a different program, right? Just a different way of doing it.
Yeah, awesome. Awesome. With that, do we have any questions, Jared?
Nope, just a few thank yous. I think hopefully, I mean, yeah, I think you did a good job. I don't think we have any questions. So, um, yeah, we're good. End early. That's a bonus. I like it.
Perfect. Well, everybody have a great day.
Thanks, you guys.